Why 37% of companies will have a different ESG score in 2026. MSCI's version 5 methodology update has already begun reshaping the scores of thousands of companies. The number that matters is 37%, and what it means for how investors read your sustainability story. In March 2026, MSCI launched version 5 of its ESG ratings methodology. The update is its most significant since the system's creation. By the company's own estimate, approximately 37% of all rated issuers will see their scores change as a result. For companies that have spent years building a sustainability disclosure program, that is not a background event. It is a direct test of whether the story they have been telling actually holds up under new scrutiny. The update introduces what MSCI calls buffer zones between rating thresholds, a structural change designed to prevent small numerical fluctuations from triggering sudden letter grade changes. Remy Briand, MSCI's head of ESG, stated that adding buffer zones should help ensure that small changes in scores do not automatically trigger rating changes. That is a meaningful correction to a system that had, for years, produced more volatility than the underlying fundamentals warranted. But the fix does not neutralize the risk, it redistributes it. What is actually changing in MSCI's version 5 update? MSCI's methodology revision goes beyond threshold stabilization. Version 5 expands the underlying data coverage, adds hundreds of new data points oriented toward financial materiality, and introduces score traceability, meaning investors and analysts can now trace a company's letter rating back through pillar scores, key issue scores, and individual indicator components. The black box critique that has followed ESG ratings for years is not fully resolved by this, but the level of visibility has increased substantially. Of the 37% of issuers expected to see score changes, MSCI's own analysis indicates that 26% reflect model-driven changes and 11% reflect data-driven changes that would have occurred regardless of the methodology shift. That distinction matters. A company whose score drops because of a data change it failed to update has a different problem than one whose score changes because MSCI reweighted an issue category. One is fixable. The other requires a harder conversation about what your sustainability program is actually measuring. Why asset managers are not the only ones exposed. The operational fallout from a methodology update of this scale is well understood in the investment management world. Firms that have embedded MSCI ESG ratings into their investment processes will need to update methodology disclosures and client documentation, re-explain portfolio ESG profiles, rerun internal reviews for strategies that breach ESG thresholds, and manage client questions about rating changes driven by methodology rather than issuer fundamentals. That is a significant operational burden, and it falls downstream from every company whose score moves. Corporate sustainability teams tend to think of rating changes as something that happens to them. The investor workflow that follows a score change is less visible from that vantage point, but the sequence matters. A downgrade, whether from a genuine performance gap or a methodology reclassification, can trigger an exclusion screen, prompt an engagement letter, or surface in a quarterly fund review. None of those conversations are easier to have when the sustainability team cannot explain exactly what changed and why. The deeper problem the update exposes, the MSCI update is significant, but it is also a symptom of a longer-running structural problem in ESG ratings that version 5 does not fully solve. Research published in the Review of Finance by Berg, Kolbel, and Rigobon at MIT found that the average correlation among 6 major ESG rating agencies is just 0.61, compared to 0.99 for credit ratings. The divergence is not random noise. It breaks down as follows. Measurement differences account for 56% of the gap, scope differences account for 38%, and weighting accounts for 6%. That means 2 companies with objectively similar sustainability programs can receive dramatically different scores from different providers, and both scores are technically consistent with each provider's methodology. For a company trying to manage investor relations across a global capital base, that is not an academic problem. It is a daily operational reality. Your MSCI score, your Sustainalytics score, and your S&P Global score may be telling your investors 3 different stories about the same set of facts. What finance and sustainability leaders should do now. The version 5 rollout has a defined timeline. All issuers received a rating action under the new model upon its March 2026 launch. Companies that have not reviewed their current MSCI score against the updated methodology are already behind the communication curve. The steps that matter now are relatively straightforward, but they require cross-functional coordination that many sustainability programs have not built. First, obtain and review the updated MSCI issuer report. Version 5 includes the new traceability features, which means you can now trace exactly where your score comes from. Second, identify which components changed and whether those changes reflect data inputs you can verify or model recalibrations you simply need to explain. Third, prepare a plain language summary for your investor relations team before they receive questions. A methodology change is not a performance failure, but it will be read as one if the company cannot explain it clearly. The broader principle here is not specific to MSCI. The ESG ratings landscape is changing simultaneously on multiple fronts. Methodology updates from providers, new regulatory requirements in the EU, and diverging standards across global markets. Companies that treat their ESG score as a static output rather than a managed relationship with a rating system are the ones most likely to be caught off guard when the number changes without warning. You've been listening to Sustainability Soundbites by Environment+Energy Leader. For partnership opportunities, please reach out to our team.